So last time we started this section on reasons to acquire or motivations, why there are merger and acquisition. And we discussed several different reasons, right? Such as large synergies, economies of scale and scope, vertical integration, expertise, monopoly gains, efficiency gains, tax savings, and diversification. And today, we're gonna finish this section, and I'm gonna start with earnings growth, and then we will talk about managerial motives to merge. Okay, so let's go to the correct page. Okay, earnings growth. So this one is really a financial maneuver. So basically, if you combine two firms, then it's possible that the earnings per share of the merged firm will actually be higher than the pre-merger earnings per share of either firm. And this will happen even the merger does not add value, right? So that's why I said it's a financial maneuver, because without value added, the merged firm will have a higher earnings per share. And you can see that from from shareholders' perspective, earnings per share is quite important, right? Because when you're valuing a firm, let's say if you're calculating PE ratio, then you will use earnings per share. And if a firm has a higher earnings per share, then this is generally considered as a good sign, because when you calculate the PE ratio with higher earnings per share, the PE ratio will be lower. However, in this case, it's a pure financial maneuver because no values are added because of the merger, but still you are getting a higher earnings per share. So let's see this example and do some calculation and see why and how this could happen. So let's say we consider two firms, and both of these firms have earnings of $5 per share. So basically EPS equals 5. And then the first firm, Upper Canada, is a mature firm with few growth opportunities, and it has 1 million shares outstanding, and its share price is $60. The second firm, Lower Canada, and let's say this is a young firm with high growth opportunities, and in this case, it has the same number of shares, so 1 million shares, but its share price is $100. Now let's say Lower Canada acquires Upper Canada, that is, the firm with higher growth acquires the firm with lower growth. And then Lower Canada will use its own stock, and let's say we assume the takeover adds no value. So there are no synergies. There are no all kinds of possible benefits you can get from merger and acquisition. Of course, this is basically a assumption in this problem. So in a perfect market, what is the value of Lower Canada after the acquisition? This is the first question. The second question is, at current market prices, how many shares must Lower Canada offer to Upper Canada's shareholders in exchange for their shares? Because we said Upper Canada will just use its own stock to pay for its acquisition. Finally, what are Lower Canada's earnings per share after the acquisition? So we have three questions. Let's first see what kind of data we have here. So both firms, right? So we have two firms. Both firms have 1 million shares. And both firms, they have the same pre-merger earnings per share, $5. And for Upper Canada, so for Upper Canada, its share price is $60. And for Lower Canada, its share price is $100. So you might wonder, well, these firms, they have the same number of shares and they have the same earnings per share, but why they have different share price? Well, if you recall the discounted cash flow methods you guys have learned in Corporate Finance 1, then basically it's because for Lower Canada, this firm has higher growth rate. And we know that if growth rate is higher, then its discounted value will be higher. So that's why Lower Canada, which is a high growth firm, has a $100 stock price. Okay, now first question. We assume it's a perfect market. And you can see that if the market is perfect and if no values can be created from the merger, then we would see that the combined firm's value should be the sum of Lower Canada's value and Upper Canada's value, right? So basically we're gonna calculate, so let's say this is the first question. So basically we will need to calculate Upper Canada's firm value, which is 1 million shares times 60. So this gives us $60 million. And then Lower Canada. So it has 1 million shares and its share price is $100. So in this case, it's $100 million. Then you can see that the total value would be $160 million. And this is essentially the merged firm's value. Second, at current market price, how many shares must Lower Canada offer to Upper Canada's shareholders to buy their firm? So this one is actually pretty simple. What I can do here is, well, because we assume at current market price. So basically we assume Lower Canada's share price would stay the same and Upper Canada's share price would stay the same. And you can see that the share price for Lower Canada is $60 and the share price for Upper Canada is $100. So this implies that if Lower Canada wanted to buy Upper Canada, it only needs to issue 0.6 million shares, right? Because its share price is 100. 100 times 0.6, this gives us $6 million. And this is exactly the same as Upper Canada's firm value. So Lower Canada will be able to use 0.6 million shares, its own shares, to buy Upper Canada's 1 million shares because Lower Canada's share price is higher. Okay, third, what are Lower Canada's earnings per share after the acquisition? Okay, so let's see. So basically you can see that before acquisition, right? Both firms have an earning of $5 million, right? Because both of them have 1 million shares and their earnings per share is 5. So both of these firms have an earning of $5 million. So the combined firm will have 5 plus 5, $10 million of earnings. And then Lower Canada initially had 1 million shares, and additionally it issued 0.6 million shares to make the purchase, right? So the total number of shares for this combined firm should be 1.6. So this gives us a earnings per share of 6 something, right? 6.25. So the interesting result here is you can see that as we have assumed, this acquisition does not create value. So that's why earnings will be $10 million after the acquisition. But you can see that before merger, right, each firm has the same $5 earnings per share. But after acquisition, the earnings per share increases to 6.25, right? So this is an interesting result, and you can see that the reason you can get this number is because after combining these two firms, the total number of shares actually decreases while the total earnings stay the same, right? Because before merger, the total earnings were $10 million and total number of shares were 2 million shares. And after merger, the total earnings stay the same, $10 million, but the total number of shares reduced from 2 million shares to 1.6 million shares. So the combined firm will have a higher earnings per share. And why do you have a lower number of shares? Well, this is because in this example, right, Lower Canada is acquiring Upper Canada, and Lower Canada's share price is higher. So when Lower Canada uses its share to buy Upper Canada, then the total number of shares will definitely decrease because Lower Canada has a higher share price, right? So in the end, the EPS will actually increase. Okay, so basically what we have got is merging a firm with little growth potential and a firm with high growth potential will raise earnings per share, right? Because we just examined this example, Upper Canada has little growth potential and Lower Canada has high growth potential. And by merging these two firms, we get a higher earnings per share. But you can see that fundamentally, this kind of merger does not add value by our assumption, right? And this will be reflected in the PE ratio. So let's see this example here. So calculate Lower Canada's PE ratio before and after the takeover in the previous example. Now, if we go back to this example, what you can see here is for Lower Canada, right? For Lower Canada, so we're looking at its PE ratio. So before merger, the price is $100 and the earnings is $5 per share. So PE ratio would be 20. And after merger, its share price is 100, and the number of and the earnings per share would be given by 6.25, 6.25, and this will give us a PE ratio of 60. Right. So what you can see here is the PE ratio of Lower Canada becomes lower after the acquisition, right? So this basically means that investors, they understand this acquisition, understand that the acquisition does not really create value. So after the merger, they will place a lower PE ratio on Lower Canada. Okay, now the last reason why we want, or why we observe firms merge with each other. This one is related to corporate governance. So basically, managers or CEOs, they wanted to merge with other firms. There are two reasons for this. The first one is empire building, and we have learned about this in corporate finance too. So the basic argument is CEOs and managers, they want to build their empire. That is, they want to make their firm larger. The reason is because CEO compensation or CEO pay is generally higher in a larger firm. And a CEO of a larger firm generally enjoys a higher prestige. The second reason is the overconfidence hypothesis or hubris hypothesis. So basically, CEOs, they become overconfident. So they will want to merge with other firms, even this firm does not create value. However, because they're overconfident, they believe they can create value when in fact no value will be created. Okay, now let's examine the process of merger and acquisition. So basically, we will want to understand how takeover process works. There are several components here. So the first, we will talk about valuation and how a acquirer or how a bidder determines its initial offer. And then we will discuss the approval of a merger and acquisition. In this topic, we will talk about several defensive tactics that firm boards will use to discourage takeovers. Okay, so the initial step, which is quite obvious, is if you're the bidder, then you need to do some valuation exercise, right? Oh, by the way, we're using these terminologies. So bidder or acquirer, right? Or acquiring firm. So these are the same, right? That is, if firm A tries to pay, if firm A tries to buy firm B, then we call firm A as a bidder, right? Obviously, if firm A tries to acquire firm B, then firm A is the acquirer or the acquiring firm. And why do we use the word bidder? Well, the reason is because when a firm tries to buy another firm, it's potentially a bidding process. Let's say if firm A, B, and C, they wanted to buy firm D, then firm A, B, and C, they will bid against each other, right? So that's why we call these firms as bidders. Okay, let's go back to the lecture note. So, valuation. A very important valuation step in merger and acquisition is the bidder needs to calculate the takeover synergies. So we learned this in the last section, right? That is one important motivation for merger and acquisition is the synergies we can get from acquisition. And you can see that this is important, right? So synergies are basically value added we can get from the merger. This is important because the price paid for the target firm will be affected by this takeover synergy. So if we recall what we have discussed, the price paid for a target firm, we know that this price has two components, right? The first component is the target firm's market capitalization. And the second component is the acquisition premium. For example, let's say the target firm has a market cap of $100 million, and then the acquisition premium is 50%. Then this means the price paid for the target firm is $150 million. And then from the bidder's or the acquirer's perspective, it wants this takeover to be a positive NPV transaction, right? Now, how do you know your acquisition is a positive NPV project? Well, as long as the synergy you can get is larger than the acquisition premium, then you would know that this is a positive NPV project, right? Because it's pretty simple. So basically, let's say you pay let's say the target firm has a market cap of $100 million. And then you will pay this $50 acquisition premium. So let's say this is the premium you pay. And this is your cost. And what is the benefit you can get? Well, you get this firm who is worth $100 million, and you get some synergies. Let's say your synergy is $60 million, right? Obviously, you can see that if the synergy is larger than the acquisition premium, then this is a positive NPV project. So after finishing your valuation process, you will begin the offering process. That is, you will make a tender offer to your target firm. So generally, you will announce publicly you wanted to purchase target firm's shares, and you also will tell the public what is your price you want to pay for the target firm's shares. Say, for example, you could say, okay, I want to acquire firm B before March the 1st, and I will purchase my target firm's shares for $100 per share, right? This $100 is the price you want to pay for this target firm's shares. Okay, so we have also discussed that in merger and acquisition, the acquiring firm can pay the target firm both with cash or stock. And if the acquiring firm is using stock, this is called a stock swap. In the stock swap transaction, the price is determined by the exchange ratio, which is the number of bidders' shares received in exchange for each target share. For example, let's say in a takeover, the exchange ratio is 2. Then this basically means that for each 1 share of target firm, the bidder has to pay 2 shares of its own stock, right? Okay. Now, we want to ask how this exchange ratio is determined. So the exchange ratio is determined by the fact that the merger needs to be a positive NPV transaction. Now, how do we know this merger is a positive NPV transaction? Well, this is simple. In the case of stock swap, as long as the acquiring firm's shareholders, their share price of the merged firm is larger than the pre-merger price of the acquiring firm, then this is a positive NPV transaction. Okay, let me maybe make a comment here. So, if this is a if it's a cash transaction, right? That is, if the bidder pays cash to the target firm's shareholders, then we want the synergies to be larger than the acquisition premium. In this case, we have a positive NPV transaction. And in the case of stock swap, we will want to make sure that the acquiring firm's shareholders, their share price will increase after merging with the target firm, right? Okay, now let's calculate the exchange ratio. So I will, what you need to know is these two formulas. However, to understand these two formulas, I will go through this very simple process to show you how do you get to these two results. So let's say we have a acquirer, and let's say the pre-merger value, right? So the pre-merger value of the acquirer is given by A, and T is the pre-merger value of the target. So basically two firms, acquirer and target. And A and T refer to their pre-merger value, their firm's value before merger. Let's call S the value of the synergies created by the merger. And we said we want this merger to be a positive NPV transaction. And how to make sure it's a positive NPV transaction, we want to make sure that the merged firm's share price is larger than the pre-merged acquirer's share price, right? So let's say the acquirer has this number of shares, NA shares outstanding before the merger. And let's say the acquirer issues X new shares to pay for the target. Now, what is the acquirer's share price before merger? Well, this is simple, right? Because we know that before merger, the firm value is A, and it has a total number of NA shares. So the share price before merger would be given by A divided by NA. Now we ask, what is the acquirer's share price after the merger? Well, after the merger, the acquirer and the target will be combined. So we get the value of A plus T. And beyond this value, we will get the synergy. So we get S. And the total number of shares, we still have this NA. And additionally, the acquirer had issued X new shares to pay for the target. So the total number of shares would be given by NA plus X. As I said, if you want this transaction to be a positive NPV project, you want to make sure that the acquirer's post-merger price is larger than the acquirer's pre-merger price, right? So we get this inequality sign here. And this will solve X. That is, from this inequality, we can solve the inequality for X. X is the number of new shares. That is, if this transaction has a positive NPV, then the acquirer can at most issue this amount of shares, right? So X has to be smaller than this amount. And then let's say NT is the pre-merger number of target shares. Right? Now NT refers to the target firm's pre-merger number of shares. And in this case, you can see we can calculate the exchange ratio, right? Because by definition, right, exchange ratio is basically the number of shares the acquirer has to use in exchange for the target firm's shares. And now the acquirer wanted to use this number of shares in exchange for NT number of shares. So exchange ratio would be X divided by NT, right? And we have obtained this inequality, right? So if we divide this inequality by NT on the two sides, then we will be able to get this inequality here. And you can see that basically this formula says there is an upper bound to the exchange ratio, right? As long as this merger has a positive NPV, then the exchange ratio cannot be higher than this amount. And then a related formula is if we define share price PT, which is the pre-merger target share price, and PA, which is the pre-merger acquirer's share price. Of course, you can see that PT equals T divided by NT because T is the target firm's pre-merger value, and NT is the target firm's number of shares. So naturally, PT equals T divided by NT. And similarly, you can define PA. Anyway, by defining PT and PA, we can get a slightly different formula for the exchange ratio. So again, it says that the exchange ratio cannot be higher than this number. Of course, the requirement here is I don't need you to understand how to prove these two formulas. As long as you can understand how to use these two formulas to calculate the exchange ratio, then that's enough. Obviously, to understand these two formulas, you need to understand what do these notations stand for, right? So the T, right, the S, A, and T. Of course, here we have PT, PA, S, and T. Okay, let's see this example here. So at the time, Sprint announced the plans to acquire Nextel in December 24, Sprint stock was trading for $25 per share, and Nextel stock was trading for $30 per share. If the projected synergies were $12 billion and Nextel had 1.033 billion shares outstanding, what is the maximum exchange ratio Sprint could offer in a stock swap and still generate a positive NPV? What is the maximum cash offer Sprint could make? Okay, so we basically have two questions. The first is we want to find out the maximum exchange ratio. The second is the maximum cash offer. What you can see here is these two formulas tells us the maximum exchange ratio, right? Because basically exchange ratio has to be smaller compared with the right-hand side. So the right-hand side gives us the maximum possible exchange ratio. Now let's see what kind of data we have here. So we have the stock price for the acquirer and the stock price for the target. And we also have synergy here. And we have the number of shares for the target. So it seems that we could use the second formula, right? Because the second formula is about stock prices. PT refers to the target firm's pre-merger price, and PA refers to the acquiring firm's pre-merger price. Okay, now, Okay, so now let's see. PT should be 30, and PA should be 25. And what is S? S refers to synergy, right? So we have 12. T refers to the target firm's pre-merger value or pre-merger market cap. And we can see that the target firm has the target firm had 1.033 billion shares and its share price is 30. So you can see that here T, which is the, again, pre-merger value of the target firm, should be equal to 30 times the number of shares, which is 31. And this gives us 1.665. So you can see that this is the maximum exchange ratio. So basically it says that if Sprint wants to acquire Nextel, the target firm, then for one share of Nextel stock, the maximum number of shares Sprint wants to pay is 1.665 Sprint stock. Okay. Second, what is the maximum cash offer Sprint could make? Recall that we learned if it's a cash offer, and if we want this transaction to have a positive NPV, then we want to make sure that synergy is larger than the acquisition premium, right? So this basically means the largest possible acquisition premium equals the firm's synergy, right? So let me write this down. So if the transaction has a positive NPV, then we know that synergy has to be larger than the acquisition premium. And we know that the acquisition price contains two parts, right? The first part is the target share price. The target share price. And the second is acquisition premium. Now we know that the target share price is $30 and acquisition premium. So what is the largest possible acquisition premium? Well, it's just the firm's synergy, right? So we have $12 billion of synergy, and then we have 1.033 billion shares outstanding, and this will give us 30 plus 11.62, which is $41.62. And you can see that this cash amount equals the cash value of the exchange offer. So what you can see here is if it's a cash offer, then the largest possible cash offer is 47.62. And if we go back to the exchange ratio, in this case, you can see that we learned the exchange ratio is 1.665. And we know that the acquiring firm's stock price was $25. So you can see that if there is a stock swap, then the cash value of the exchange offer is 25 times 1.665, which is $41.62. Okay, next let's talk about merger arbitrage. So merger arbitrage is more related to investment. It's a very important investment strategies. There are a couple of hedge funds which actually specialize in merger arbitrage. So merger arbitrage is based on this observation that if the acquiring firm announces it wants to acquire a certain target firm, there will be uncertainty whether this merger will be successful or not. And this uncertainty will actually create an opportunity for investors to speculate on the outcome of the deal. That is, whether it will be successful or not. And these investors are called risk arbitrageurs. Importantly, merger arbitrage is called arbitrage, but it is not a true arbitrage opportunity because at least in finance textbook, arbitrage is defined as riskless profit. However, in merger arbitrage, there is always risk. The risk is possibly the deal will not go through. So there is this risk. Okay, let's see how the merger arbitrage process actually works. So in September 2001, HP announced they would purchase CompactQ by swapping 0.6325 shares of HP stock for each share of CompactQ stock. So you can see that we have a exchange ratio here, right? This is not a cash offer. It's obviously a stock swap. So the exchange ratio here is 0.6325. Now, after the announcement, HP's stock was $18.87 per share. And the implied value of HP's offer, you can see that it's this 18.87 times 0.6325, which is about $12, right? Now, the price of the CompactQ firm was just $11.8 per share. So you can see that there is a difference here, right? Because according to HP's offer, CompactQ's share price should be this, about $12. But the actual trading price for CompactQ was just 11.08. So basically you can see that the difference is 0.8553. First, why do we have this difference here? Well, if you know the deal will go through, right, then CompactQ's share price should rise to about $12 because that is what HP would pay for CompactQ's shares. However, after the announcement, shareholders really don't know whether for certain the deal will go through, right? So there is this uncertainty. That's why there is this difference here. Now, let's see how can you construct this merger arbitrage strategy and earn money from this. So let's say there is a hedge fund, right? It specializes in merger arbitrage. And after this announcement, it can build a long-short position like this. So it will buy 10,000 shares of the target firm and it will short 6325 shares of the acquiring firm. So why do you want to do this? Well, it's pretty easy, right? Because you can see that the target firm's share price was actually lower than the price implied by the acquiring firm's offer. So this basically says the target firm's share was relatively undervalued and the acquiring firm's share was relatively overvalued. So that's why you would want to take a long position in the target firm and a short position in the acquiring firm. Now, why do you want these numbers? Well, you can see that for a long position of 10,000 target firm's shares, you will want to build a short position of 6,325 acquiring firm's shares. Why do you do this? Well, it's from the exchange ratio, right? Okay. Now, what is your initial profit? Well, your profit is given by, so you short sell 6,325 HP shares at its market price. And then you will buy 10,000 shares of the target firm's shares at a price of 11.08. So this will give you a price of $8,553. Now, if the deal will go through, if the takeover was successful, now you can see that in the end, this 10,000 compact shares will be swapped, right? Because of the exchange ratio, we learned HP will swap 0.6325 shares for 1 share of compact stock. This basically means if the deal went through, 10,000 target firm shares will become 6325 acquiring firm shares. And then the beauty is you can see that due to the exchange ratio, your long position and your short position will just offset with each other, right? So you will close out your position when the deal went through. And in this case, you will pocket this difference. You will earn $8,553, right? So you can see that this kind of profit arises from the merger arbitrage spread. Here, this spread is defined as the difference between the implied offer price and the target stock's price. Okay. So this looks like a very simple and easy to understand way of earning money, right? But merger arbitrage is not risk-free. As I said, you will earn money if the deal finally went through. If the deal broke up, you will actually lose money. And even if the deal finally went through, during the process, right, that is, from the point when you built your position to the point when the deal finally went through, your portfolio would still go through a lot of downs and ups. Okay, now let's talk about board and shareholder approval. So basically, if we want a merger to proceed, the first step, the basic step is both the target firm and the acquiring firm's board of directors, they have to approve the deal, right? Oh, by the way, clearly you have to understand the basic structure of the firm, right? So basically, you have board of directors, and then you have CEOs, and then you have other C-levels, right? CFO, COO, CMO, right? That is Chief Financial Officer, Chief Operating Officer, and Chief Marketing Officer. So supposedly, board of directors should monitor the CEO, and board of directors should also advise, that is, help the CEO. So that's like the basic structure of modern public firms. And if you want a merger to proceed, the board of directors of the both target and the acquiring firm, they need to approve this deal. And next, the target firm's shareholders, they will need to approve this deal. And a lot of times, acquiring firm's shareholders also need to approve this deal. So there are, you can see that there are several major steps if we want the merger to actually go through. Okay, so depending on whether the target firm's board of directors wanted to approve the deal, a takeover can be friendly or hostile. So if a target's board of directors supports the supports this merger, then this is a friendly takeover. If the target board, they don't want to approve this takeover and they fight this takeover, then this is a hostile takeover. So in the case of hostile takeover, if the acquirer still wants to succeed, it has to get enough shares, enough votes to take control of the target firm and replace the board of directors. And if a takeover is hostile, the acquiring firm is also called a corporate raider. Now, you might ask, so why target firms, board of directors, and management will want to oppose a takeover? Well, there are at least two reasons. The first reason is the target firm's board think the offer price by the acquiring firm is too low. So in this case, the target firm will want a better price. Or the target firm thinks the acquiring firm's shares are overvalued. So in this case, the target firm will not want a stock swap. And there's this second reason. The second reason is maybe the board and the management of the target firm, they want to oppose the takeover because they want to protect their own self-interest. For example, the target firm has inefficient management. Well, in this case, if a takeover happens, then the acquiring firm will just remove the inefficient management. So you can imagine that the inefficient management of the target firm will not want the takeover to happen. So they will naturally want to oppose the merger because they can protect their jobs. Okay. Okay. So let's continue this topic. That is, some firms, right, they will oppose takeover. There are different ways a target firm can oppose the takeover. So we will talk about takeover defenses. So first, if it's a hostile takeover. Now, if the acquirer wants to succeed, then it has to go around the target firm's board of directors. And they will have to get votes from the target firm's shareholders. And this is achieved through proxy fight. So basically, what happens is the acquiring firm will try to convince the target firm's shareholders. And the purpose is they want to convince these target firm's shareholders to remove the current board of directors. And the acquirer will put their own candidates. They will elect their own candidates to the target firm's board. So what you can see here is basically after the annual meeting, if this proxy fight is successful, then the acquirer will be able to remove old opposing board of directors. Then the acquiring firm will put its own guys, its own candidates as new directors of the target firm. And then these new directors, they will basically agree to this takeover, right? Now, there are several defenses these firms can use to stop this hostile takeover. The first one is called poison pills. Poison pills. So it is a rights offering. Remember that we discussed security offering. There are two kinds of offerings. cash offering and rights offering. So cash offering means additional shares can be only sold to existing shareholders. Cash offering means additional shares can be sold to anyone with cash, with money, right? So poison pills is a rights offering, which gives the target shareholders the right to buy shares in either the target firm or the acquiring firm at a deeply discounted price. And you can see that this will deter hostile takeover because under this poison pills, target shareholders, they purchase shares at a deep discount. This basically means acquiring firms' shareholders, they are subsidizing target firms' shareholders. And this will make the takeover expensive for the acquiring firm's shareholders. So they will choose to pass on this deal. Okay, the second important mechanism to stop a hostile takeover is called Staggered Board. It's also called Classified Board. So basically the motivation is like this. We know that the poison pill will deter hostile takeover, but the acquiring firm can actually get its own directors elected to the target firm. Then these new directors will be able to cancel the poison pill, and then the acquiring firm will be able to acquire the target firm. So to prevent this, the target firm can use Staggered Board. Here, Staggered Board or Classified Board basically means board of directors terms, they are staggered, such that only one third of the directors are up for election each year. And you can see that this will make takeover harder because let's imagine this. Let's say the acquirer wants to get its own directors elected to the target firm to cancel this poison pill. And you can see that, let's say the acquirer is successful for one time. But you can see that even the acquirer is successful for one time, it will only be able to replace 1/3 of all directors. So this is not majority, right? Because if you require a majority of votes to cancel poison pills, then you have to make sure you will get at least 50% of the votes from board of directors. Now you can only get 33%, so you will not be successful. This means you have to, as a acquirer, you have to win this proxy fight for a second year to get your own directors to the target firm's board. In this case, right, you will have about 66% vote. Then you can remove this poison pill. And you can see that this is hard because winning one proxy fight to get your directors to the target board is hard. Winning 2 proxy fights 2 years in a row is even harder. And next, White Knights. Well, this is a nice name. It basically means that if there is a hostile takeover, then the target firm will just look for a different, friendlier White Knight firm to acquire it. Next, golden parachutes. This is a very interesting phenomenon in corporate governance. So first, what is golden parachute? It basically means that if you're the CEO or other C-level executives in a firm, if the firm gets acquired and if you're fired, then you will get a lot of money, right? So it's a very large, lucrative severance package senior management can get if the firm is taken over and the managers are let go. So generally the public and the media generally will criticize golden parachutes because they think that golden parachutes are essentially making managers richer at the cost of shareholders. But if we look at data, the empirical result, the empirical evidence actually suggests the opposite. That is, by research, we find that the adoption of a golden parachute actually creates value. So what are kind of evidence we have here? The first is we find stock prices generally increase if a firm announces it plans to use golden parachute. And the second evidence is the takeover premium is generally higher if the target firm has golden parachute. So why do we observe these results? Well, because golden parachute will benefit managers. So this implies that managers will be more receptive to a takeover. And we know that takeover can remove inefficient management. So this basically means this will reduce the likelihood of managerial entrenchment. Okay. Next, recapitalization. So recapitalization could also serve as a way to deter hostile takeover. The basic reason is because a firm can increase its leverage to make itself less attractive as a target. So the explanation is like this. A large portion of synergy gains is from interest tax shield. So you can see that if the target firm increases leverage on its own, then the target firm can reap the benefit of the interest tax shield, right? So this will basically reduce the synergy gains, and it will make the acquisition less appealing to the acquiring firm. And then the second reason, well, we have learned about this. By increased debt, managers will be more motivated to run the firm more efficiently. And if the managers, they can run this firm more efficiently, then this will actually remove one motivation for takeover to, this will remove one motivation for the takeover in the first place. So the argument here is like this. Why do takeover happens? Well, one reason is because the acquiring firm thinks the target firm's management is bad, right? These managers, they are inefficient. So the acquiring firm will want to acquire the target firm and fire these bad managers, improve this target firm, right? However, you can see that if that motivates managers operate in a more efficient way, then the reason for acquisition will just disappear, right? Because now we don't have inefficient managers at the target firm. Instead, we have efficient managers at the target firm. Okay, there are also some other defensive mechanisms the firm can use to deter hostile takeover, such as the firm can require a supermajority of votes to approve a merger. Well, this is simple, right? Because generally, shareholders only need a majority to approve a merger. Here, majority means the percentage of votes for merger has to be larger than 50%. Obviously, the firm can increase this threshold using supermajority. Let's say if the firm says, okay, a merger can only be approved if over 80% of shareholders will want this merger to happen. Then in this case, you can see that this is a supermajority, and it might be difficult to achieve this 80% percentage, right? And a firm can also restrict the voting rights of very large shareholders. So you can see that this will make takeover harder. Let's say the acquiring firm acquires 50% of the targeted firm's shares. But then the targeted firm says, you're a large shareholder. You have 50% shares. Your voting rights will be discounted. So in this case, you can see that because the large shareholders' shares have lower voting rights, then it will be harder for them to vote for merger to happen. Then a firm can also require a fair price to be paid for the firm. So basically this says the management can just tell the acquiring firm, hey, we don't want your takeover because we think your price is too low. But you can see that this can be used as a way to deter takeover, because what is a fair price is fairly subjective, right? The determination of what is fair will ultimately up to the board of directors or senior management of the target firm. Okay, now we still have some time, so let's talk about who gets value added from a takeover. So we learned that if a merger happens, then there could be some synergies, right? And this synergy can be considered as value added from a merger. And we want to know whether the target shareholders or the acquiring shareholders will get this value added. Well, if we look at data, empirical evidence says that target holders, they almost capture all the value added from the merger. Why do we get this result? Well, it's because the acquisition premium is roughly equal to the value added, right? And acquisition premium is the money or additional money paid to the target shareholders. So that's why we say target shareholders, they capture the value added from the merger and acquisition. Our task is we want to understand why. Okay, so let's say the current price of the target firm is 45 per share with 1 million shares. Let's say the acquiring firm will acquire the target firm and it will make some improvements. So this will make the target firm's stock price increase from $45 to $75. Now let's assume the acquiring firm makes a tender offer of $60 per share. So basically the acquiring firms can gain $15, right? Because the cost here is $60. And after acquisition, if the takeover is successful, the target firm's share price will increase to $75. So you can see that the gain is 75 minus 60, which is $15 per share. Now, one important question is, will target firm's shareholders want to sell their shares to the acquiring firm at $60? Well, the answer is no. And the reason is really easy to understand. If all the target firm's shareholders, they understand that its share price will increase to $75 after the takeover, then obviously they will not want to sell their shares at $60 before takeover, right? So this basically means that the deal will not go through if the acquirer wants to pay $60. Nobody from the target firm will want to sell its share. Now, how the takeover can be successful? Well, the only way is the acquiring firm will have to pay target shareholders at $75 per share, right? This basically means that in the end, the acquiring firm will have to pay $75. So this means the final gain for the acquiring firm is just $0, right? So this basically means that the value added from the merger is captured by target shareholders. And acquiring firm's shareholders, they get just 0. So this is called free rider problem. This is a free rider problem because basically the target firm's shareholders, they don't need to invest time and effort to improve the target firm, but they still get all the gains from the takeover that the acquiring firm will generate, right? So basically, target firm shareholders, they will free ride the acquiring firm's shareholders. So this is a free rider problem. And because of this free rider problem, the acquiring firm will have to give up almost all its profits from the takeover. Okay, so we will talk about how to solve free rider problems in the next class. So we will stop here today.